For more on this, let's bring in former Council of Economic Advisors, Acting Chair Tom Philipson. Tom, thanks so much for being here. So with the new Fed chief, the continued obsession will be lowering interest rates, keeping rates down to finance our debt. About a third of it, $10 trillion, has to roll just in the next year. But if you look at, say, oil prices, gold, silver, and copper, gold and copper near all-time highs, the dollar falling to a 4-year low, investors are saying it looks like inflation is ticking up and going in the wrong way. How do you see all this? Put it together.
No, I think the Fed needs to change their view. I think that Trump is correct. The Fed's view has been for many decades that economic growth essentially causes inflation. That is not borne out by the data at all, and that's why we have this problem we're currently having, which is that we have inflation coming down essentially, and the Fed is afraid of lowering rates. And it's a weird thing, because when we have goods inflation, we had 23% inflation under Biden essentially during many years together. We raised inflation on credit to more than 100%. You know, mortgages went from 3.5% to 7%. That's a doubling of mortgage checks essentially. And it's the same for interest payments for the government. And that's what the president is concerned about, that when you have double rates, you have double interest payments for the government. And I think that's a correct concern. I don't think there's any dangers of lowering rates further.
So, okay, Tom, by the way, we had an awesome debate about all this on the Big Money Show today. And we had Larry Kudlow on. And of course, like you know, he's really bullish about 2026, okay? A lot of juice in the pipeline, capital expenditures, GDP growing. Great. Do you see that translating in a big way in 2026 when it comes to wages and jobs? Because I feel like that's where it really hits the road for most people, and where they feel like, okay, this whole Trump economic agenda is really working for me.
Yeah, I think already we have real wage growth under Trump, which we had negative real wage growth under Biden, obviously. And I think it's going to be a good 2026 and 2027. If you look at the markets, they are forward-looking, obviously, and they certainly think it's going to be a good 2026 and 2027. It's a little puzzling, I think, with all this good things that are going on, why sentiment is really at a 12-year low, really, consumer sentiment. And it's also puzzling why consumer spending is strong when you have such low sentiment. I think it's partly due to the press, where economic press is different from weather press. Weather's not affected by how we report on the weather in the press, but the economy can be affected when you turn on the TV every time or go to your social media. There's bad news about the economy. That will certainly affect consumer sentiment. It could be self-fulfilling.
And well, speaking of impacting sentiment, just like avert your eyes, or basically close your eyes and ears when you hear about what Mayor Zoran Mondani wants to do to New York City, because it might be coming to a city near you. Less than a month to demand took him less than a month to demand a tax on the wealthy in order to fix the city's $12 billion budget gap, which he blames on his predecessor. Listen.
We are speaking about a fiscal crisis at the scale greater than the Great Recession. It means that the time has come to tax the richest New Yorkers and most profitable corporations. We're looking to raise income taxes on the top 1% by 2%. So for $1 million a year, that's an increase of $20,000 in taxes.
How many more people does he want to drive out of New York City and New York State? I just got these numbers from the Empire Center. New York State added just 1,008 new residents last year. This is from the Census Bureau running through July. And U.S. residents, not including immigrants, continued moving out of New York City faster than they moved in. I think that it was only offset by so-called natural growth of 43,000. So it was like ranking one of the worst states in terms of people just heading for the hills.
Yeah, I mean, they're digging their own graves, their own socialist graves, it seems to me, because It used to be before 2017, when we changed the tax law, it used to be that socialism on the local level, you could have socialism without taxation because the local and state taxes were deducted from your federal taxes, right? That changed in 2017. Now you have to pay the full price for a big local government. And what happens? The people who are paying the price leave, essentially. You know, the one percenters in California, which is also going ahead with the crazy policy trying to tax wealth by 5%. The one percenters in California and New York are responsible for 40 to 50% of local taxes. So it's just digging their own grave. They can't finance their government off the rich alone, essentially, because the rich leave. And I think that's going to be the course of both California and New York. It's going to go down the tube, essentially, if they continue like this.
Well, we got more California talk later, but before we go, I want to get your take on this. This is your big think topic of the day, Tom, okay? So you got an op-ed in the Wall Street Journal warning that Washington is bracing for the wrong AI moves and the wrong AI employment shock, writing, quote, AI will disrupt labor markets, but disruption isn't synonymous with destruction. The danger isn't that AI will eliminate work faster than society can adapt. It's that governments will intervene where they shouldn't and neglect help where they should. Tom, is that the real issue here? Panic is a bad idea because it gets government involved in the wrong ways in the economy.
Yeah, I mean, the history has been, we had massive technological change in terms of increased productivity in the past with an increasing labor force. That's been the history. Look at agriculture, where you all used to be, you know, in our agriculture and agricultural economy, we didn't lose all those agricultural jobs and then everyone was unemployed when we went from, and today, basically 2% of the population make us obese. Before it was agricultural economy and we had starvation, essentially. Enormous productivity gains. Same with manufacturing. Manufacturing is down to less than 15% of the economy because it's so automated right now and in terms of employment. The services is about 80%. So all that technological change will happen with a growing labor force, essentially.
Right.
What's different now is the speed, and even AI companies are concerned with that speed, and I think that's a little bit different now than before.
And you saw during the cloud movement, the migration from hardware jobs to software jobs like that. So easily adaptable.